Hello, Marc Ostwald from ADM Investor Services International. With some thoughts this week on the steepening that we've seen in the US yield curve and what it might mean and why it might be going in that particular direction. So I'm going to start with the US and then make some comparisons with both Japan and Germany. But let's start with the US. The US 10-year spread is always the one that a lot of people look at. And as one can see, we were almost back at flat in the third quarter of last year. And now we've gradually been climbing. But given the previous history over the past 5 years, it's hardly been a dramatic climb. We were much, much steeper at the end of 2016. But nevertheless, it seems to be threatening to break up through certain levels. And at this particular point, one will probably have to ask why. And the primary reason, I think, is without a shadow of a doubt that whoever wins the election, they're expecting them to spend large. And whether one takes it as a Trump budget, which would probably take US debt to 125% of GDP, or a Biden budget, which would probably be about 128% of GDP, it's fairly immaterial. The implication is that the US has borrowed a lot this year and is going to borrow even more going forward after the election, particularly once the election is out the way and there's less politicking going on. But that one is less dramatic than the 5-30-year spread, and this is interesting in the context of Fed policy. So my next chart is the 5-30-year spread. And as one can see, that has had a far more dramatic jump from the very low 20s in the middle of 2018, and we're now at 128, breaking through those big levels, seemingly headed for the highs that we saw back in 2016 of 140 basis points, which brings me to the question, well, the Fed has basically for the time being said it's not going to deploy yield curve control, but what point in this steepening of the curve does the Fed feel like it would be necessary to act? Eminently, it's not going to set a 30-year yield control target, but it probably will set a 10-year one, but with an eye to that 5-30-year spread, which is getting inordinately steep. How does this compare with what's been going on elsewhere? Well, the two final charts I have for today are the German 10-year Bund versus the US 10-year Treasury. As one can see, it's climbed very sharply at the peak of the COVID outbreak and was basically trading sideways for quite some time after the markets have been stabilized by the G7 central banks. But it's of late, we're starting to get to a point where the spread into the US is making it quite attractive to go back into dollars from bunds. And particularly given that we've seen a lot of compression in the euro area space. My final chart is the Japan US 10-year spread. Now, as one can see, that has been basically at a level where really one had to say when we were down at that 50 basis point pickup out of 10-year JGBs into US Treasuries, where it was almost not worth the trip for Japanese investors. Now it's starting to widen out again, and one would have thought this should be somewhat supportive for the dollar. But I think in the first instance, what one has to remember is the comments that we've had from both the hawks and the dove, Mr. Rosengren and Mr. Kashkari, saying that the Fed is going to be far more aware of financial conditions and above all the risks of credit bubbles. And I think that is going to be one of the key arbiters of whether they choose to deploy yield curve control or deploy it with something which basically tries to rein in the excessive risk taking, as they call it. So plenty to ponder on that front.